Hi, good morning, everyone. Rob Lukey with Shop Prop Realty and Our Capital Group. I wanted to take a second to go over real quick the Case Shiller Index and the long-term housing view and short-term. And then I also wanted to talk real quick about Shop Prop Realty and Our Capital Group. Shop Prop Realty, as most of you know, we're interested in changing the way people buy and sell real estate by putting more money back into our clients' pockets. We've recently went over the $3 million mark in the way that's money actually given back to clients or saved. And that's money that normally would have went into a full commission agent's pocket. It would have been completely lost. Well, not lost, it would have went in their pocket, but it would have been lost to our clients. So what it does is it obviously enables our clients to get into homes at a better price than their neighbors that don't use Shop Prop Realty. Uh, going on, and as most of you know, you're going to typically what our clients do for that is they're going to do initial legwork themselves, finding properties they're interested in, let us know when they're interested in seeing the inside of, and then we take it from a full commission standpoint from there. Our Capital Group, our goal there is to buy and sell properties on a short-term basis for ourselves and for our partners. We buy and sell properties, we have them and so forth. On a past performance standpoint, if you don't have an account, you can always go and see how we're doing overall and as far as percentage-wise and so forth. If you do have an account with us, the nice things about our Capital Group is that it's very transparent. You can see that you actually own the property. You can see it via tax records, and you can see there's no loans on the property. You can see when it's listed. You can see the work that's being done. So it's a very transparent investment from that standpoint. You can also, by logging into your software, see, for example, I own this property, what's going on with it, click on it, see obviously the information on it and so forth, the rehab that's been done and so forth. So you can go ahead and do that. You can also, if you're interested, you can either be a passive investor. Passive investor simply can put in an order that says invest, $50,000 into the next, let's say, at OCG's discretion, or if you want 2 properties, you can say at the next 2 properties, and I just want to invest in Orange County, and you can simply say agree, and you can go ahead and place your order. That means that you get put into a queue, and now you can see that you have a passive investor. You're put into a queue. It's a first in, first filled basis. You're filled on the next properties that you buy. We handle the rehab. We list the property, sell the property, and obviously from that standpoint, we don't charge a commission. We simply charge a percentage of the profit. So if we don't make any money, if you don't make any money, we don't make any money. So the idea is that we're looking to we have some skin in the game in every aspect, not only by owning a piece of it, but also by that's how we end up making money on those particular investments. So getting on to the Case Shiller Index, and if you don't want to do that, you can also still obviously search for properties that you may want to buy either in California or Washington State. Okay, just by clicking search, and you can see properties that have opening bids, hot properties, and so forth. Okay, so getting back to the Case Shiller Index, here's the long-term chart since the Case Shiller started keeping track of home prices or collecting data. And the S&P Case Shiller is the most widely used indexes when it comes to obviously the home prices. And as you can see, obviously we've beat inflation year over year. That's not saying that you cannot have drops. For example, this has been a huge drop and actually the biggest that we've seen since they started collecting data. But overall, it's beaten inflation, not by a huge amount, but year after year. Real estate seems like it's a fairly safe investment when it comes to that. Overall, as far as the Case Shiller, here's the Case Shiller Index, and as you can see, we were up around 14%. The top of the market so far on this recovery has been about March or April, depending what market you're in, of this year, maybe mid-May, and since then we've seen home prices drop. Now, what you see is there's a deceleration in home price gains, but when you see that, for example, if we're increasing at 14%, which is what we were doing, and now we're increasing at 5%, we still slowed down significantly it during that time, about, let's say, close to 8% over a period of 4 months, 4 or 5 months, right? So actually, not only did we see home prices come off a little bit, but we saw the deceleration. Now, the good news is that it's still increasing at 5% year over year. So obviously, if we have a 5% increase, right, over the next, let's say, year, obviously we're back up and have actually blown through those numbers that we set at the beginning of this year. Going on and taking a look at the deceleration, there are some good news numbers. Housing starts picked up, and permits and sales of existing homes, those were all up. That's showing that it's starting to clear out that inventory. Remember, we had a lot of inventory come on because home prices came back up, and now we're clearing out some of that data. And you've seen this little tick down. This is the U.S. National Home Price Index, which is back up to spring of 2005. It was a little higher. And then obviously you had this little bit of a delay, and we're basically at autumn 2004 levels. From the bottom to the high, we've seen to where we are right now, we've seen a recovery of about 28.8%, 29.5 in the 20 city day composite, which is what this is. 20 city day is the dash line, and this is the 10. And then we still have about 16 to 17% off our highs overall. So if you take a look, this should have been highlighted with Los Angeles and Seattle, where we currently buy and sell. You can see that we've basically seen, month over month, a little bit of a slowdown overall from the difference in the change, both in Los Angeles and in Seattle. And the seasonally adjusted numbers, these are the non-SAA numbers. If you look at the seasonally adjusted again, we're off a tiny bit. So anyhow, overall, my thought process on the overall market has not really changed, and that is that we'll see this choppy movement up. And actually, this is the chart. We've already seen a drop, this type of move back down in late 2012. So it's kind of been a typical move, really, that we see this, and then maybe at the beginning of next year we start to see these things pick up from a seasonal standpoint, number one, but also just from a standpoint of we've seen this drop back off from the high that we set back in May. So overall, I do think that we're going to break through our 2006 and 2007 highs maybe over the next 3 to 5 years. That's my thought process on the overall market, but it'll be a choppy move up there. Hope everybody has a great day, and thanks for listening.